Aloha, my name is Leilani Dela Cruz. This is my annual report project on Adobe. So the contents we'll be going over is all the sections in the written report. So company information, the overview, the annual report, balance sheet, income statement, current assets, long-lived assets, liabilities, stockholder equity, statement and cash flows, and the overall evaluation based off of what I researched. First, we'll go over the company information. So the headquarters of Adobe is located in California, more specifically 345 Park Avenue, San Jose, California. The CEO and chairman of the board is Shantanu Narayan. He was the CEO of Adobe since 2007 and the chairman of the board since 2017. The sector industry of Adobe is technology, while the industry classification is computer software or prepackaged software. According to the market data, the stock exchange is in NASDAQ. The ticker symbol is ADBE, so how you spell Adobe minus a zero. The stock price at the end of the day, within the past week, I got this data on May 1st at 7:51 p.m., is $374.15. The 52-week low within the past year is $274.13, while the 52-week high within the past year is $451.15. And according to its website, the revenue from its most recent fiscal year is $17.61 billion, US dollars. That concludes the company information. Next, we'll go over the overview of the annual report. So the person in charge of preparation and integrity of the financial statements is Daniel Dern. He is the Chief Financial Officer for Adobe. I found this through most of the documents. Does Adobe have a system of internal controls? Yes, they do, for security purposes. Do they have an audit committee? Yes. They work closely with the board of directors to oversee accounting and financial processes throughout the country. Not the country, the company, sorry. They do have a independent public accountant or an auditor, which is KPMG, Limited Liability Partnership. They are responsible for reasonable assurance for the financial statements and ensuring that they are free from misstatement, aka errors and fraud. Their opinion is that financial statements provide fair views of the company, and it suffices as evidence to back up their opinion. That is a quick overview. We'll go over the balance sheet next. So first we looked at calculating assets and the current ratio. So to calculate assets, you need to add liabilities and stockholder equity based on what is written in the balance sheet. And for current ratios is current assets divided by current liabilities. I calculated this based off the balance sheet for 2022 and 2021. So the assets for 2022 is $27,165,000. The math is included. For 2021, it is $27,241,000. That is a little bit higher than 2022. For 2022's current ratio is 1.11. While the 2021 current ratio is 1.25. Again, 2021 is a little bit higher than 2022. And I also included the balance sheet within the slide. You can take a few seconds to look over it. This is also included within the written report. But this should conclude the balance sheet section. Next, we'll be going over the income statement. So we calculated 4 things, but on this slide, we go over the first 2, which is the gross profit rate, which is gross profit divided by net sales, times 100 to get the percentage, and the operating margin, which is operating income divided by sales, times 100 to, again, get a percentage. I use 3 years instead of 2 now, so we calculated for 2022, 2021, and 2020. All the math is on the screen, so I'll just read off the overall total. For 2022, the gross profit rate is 87.70%. the gross profit rate for 2021 is 88.19%, and the gross profit rate for 2020 is 86.62%. For operating margin, 2022 has a 53.07% operating margin. In 2021, Adobe had a 51.43% operating margin, and in 2020, they had a 53.69% operating margin. So to elaborate on some of these things, gross profit measures the efficiency of a company's ability to operate. So the higher the gross profit rate, usually the more control a company has over its costs, while on the other hand, the lower the gross profit rate, the less control they have. So you can see that Adobe keeps around a high 80%, if you round it up, it's close to 90%, which means they have pretty much a great control over their finances and costs. There's minimal changes between the years, as you can see a 2% increase from 2020 to 21, and a 1% decrease from 21 to 22. And that should be a brief summary about that. As for operating margin is the measurement of the profit on dollars of sales. So this excludes variable costs, it excludes variable costs, or includes variable costs, I should say. Sorry, I think I wrote this wrong, but it does not include interest or taxes. Or excludes variable costs, but not interest or taxes. Sorry. But you can see that over time, it kind of stays around the same area-ish. It's like a 53%, but the lowest being 51% in 2021. So from 2021 to 2022, they increase the profit they get from their sales, from every dollar of sales. Next, we'll go over the profit margin and return on assets. So profit margin is calculated by net income divided by sales times 100, again, for a percentage, while return on assets is calculated by the net income divided by total assets. All the math is on the screen again, so I'll just read it off. Profit margin for 2022 is 27.04%. In 2021, it was 30.55%. In 2020, it was 40.88%. Profit margin is the profit amount in cents companies make for each dollar of sale. Instead of profit, it's in general, you can be profit cents or profit in cents. You can kind of see there's a big decrease from 2020 to 2021, even to 2020 to 2022. So there's a 10% decrease and then a 3% decrease from there. So there hasn't been any details as to how they're trying to improve upon this, but so far it's kind of more of a loss rather than a gain. Return on assets, on the other hand, is the profitability a company has relative to its total assets. So this is a measurement in decimal form. So the lower the ROA is, usually it's less profit. So you can see the profit goes down over time from 2020 to 2022. This can partially be because of the pandemic hitting. Yeah. I also included the income statement for Adobe. It's kind of spaced weirdly, but is also on the document. I'll let you have a few seconds to look over it if you want to. And that concludes the income statement portion of Adobe. For Adobe, next we'll be going over the accounts receivable. So I recorded the amounts for 2022 and 2021. So the accounts receivable amount for 2022 is $2,065,000, while in 2021 it is $1,878,000, which is, of course, an increase in receivables. The amounts before subtracting the allowance of doubtful accounts, I wasn't confident in this information, but in 2022 it was $23 billion, and in 2021 it was $16 billion. After you subtract it in 2022, the balance is $2.07 billion, while in 2021 it is $1.88 billion. So the amount of this allowance of doubtful accounts would be $20.93 billion in 2002 and $14.12 billion in 2021. I'm going to skip over the inventory a bit, but you can see that there's no information regarding inventory. But for the amounts of COGS, cost of goods sold, in 2022 they made $2,165,000, and in 2021 it's $1,865,000. Next, we'll be going over the ratios provided with accounts receivable. Because there's no information regarding inventory, there will mainly be two. So the inventory turnover and average days inventory held will not have information. So if you look on this slide, you can see receivables turnover and average collection period. The math is there, but this is for 2022. So receivables turnover is the sale divided by net average receivables. I'm so sorry. That calculated to 8.93. So you can see the net average receivables is the $2,065,000 plus $1,878,000 divided by 2 for the average, and then that is the denominator, which you divide from 17,606,000. And from there, you can just use that receivables turnover to find the average collection period, which is 41 days when you do 365 divided by 8.93. So what do these ratios represent? Receivables turnover is the company's efficiency in collecting debts and extending credit. The average collection period is how long it takes companies to convert their receivables into cash. So this is 41 days. That means, well, from receivables turnover, they kind of collect it around 9 times a year within 41 days. The receivables turnover can be considered low, but then it depends on the industry. I think for the tech industry, which is what I mainly looked into when looking into these ratios, it is fairly low. On the other hand, they have a high liquidity rate because of the amount of days it takes to collect these receivables. So the longer, or the more days you have, the higher the liquidity is. So they have a bit of a higher liquidity, or they are on the higher liquidity side. This is my brief explanation about accounts receivable. So we'll be talking about the long-lived assets next. This is the general information regarding long-lived assets, or like the plant, property, equipment. So I couldn't find concrete information on their depreciation method, but from one website it said it was straight line depreciation method. In 2022, their depreciation expense was $169,000, while the depreciation expense in 2021 was $172,000. The intangible assets for 2022 is $1,449,000. In 2021, it is $1,820,000. I'm so sorry. In 2020, it was the $1,359,000. They do have intangible assets. It usually consists of like the patents, trademarks, copyright, etc. They also have goodwill recorded. So in 2022, they have recorded $12,787,000. In 2021, they recorded $12,721,000. And in 2020, they have recorded $10,472,000. So you can kind of see like the difference from 2020 to 2021. Capital expenditures in 2022 was $442,000, while in 2021 it was $330,000. Also a pretty big increase. The capital expenditures ratio is when you take the cash provided by operating activities and divide it by the capital expenditures. You can see that on the bottom. We can talk a bit more about cash provided by operating activities later on. So in 2022, the cash expenditures ratio was 17.73, while in 2021 it was 21.89. That capital expenditure ratio is actually pretty high. From researching, is like, I think 10 or 15 would be good, or I think it's like 20 to 25. Usually the higher it is, like, the better the investment is, I believe. Or actually, I take that back. It proves that, like, they can purchase more properties, more PPE, I should say, without having the additional external financing to aid them. And they can also cover more of the expenses that come along with it. And if needed, they can just buy new equipment. Next, we'll go over the ratios. So I think we have all the information for this one, so you'll see more information. The average useful life for plant assets is the average cost of plant assets divided by the depreciation expense. So in 2022, it is 0.45. In 2021, it is 0.48. And in 2020, it is 0.50. The average age of plant assets, these are two different things, is accumulated depreciation divided by depreciation expense. So when you're reading this, it is in 2022, the average age is 1.83. I'm assuming it's like years, but I'm not completely sure. In 2021, it is 1.84, and in 2020, it is 1.98. This part is kind of self-explanatory, just shows how long assets live within the company. So the ratio isn't particularly high, but Adobe can like cover that with the capital expenditures ratio. Next, we'll go over the assets turnover and another return on assets. So the assets turnover is calculated by sales divided by average total assets. In 2022, this was calculated as 0.65. In 2021, it is 0.61, and in 2020, it is 0.57. The asset turnover ratio shows how efficiently companies can use their own resources to make revenues and sales. So this ratio is usually around 0.55 to 0.65, but you can see it's increasing over time, which is, I guess, is kind of bad because it shows that the resources are not as efficient as expected, since I think the expected is 1.0 and above for technology companies. It's slightly below that, but you can see over time they are increasing their efficiency. The return on assets is calculated by net income divided by the average total assets. So in 2022, it is 0.18. In 2021, it is 0.19. And in 2020, it is 0.23. This return on assets shows the profit companies can produce from its assets. Yes. So you can see it's around 20% if you change the decimals to percentages. However, it's been decreasing over time. So at face value, I think if you look at it in a general perspective, this is like a good return on assets, but within the technology company is a little bit below it. I believe the expected ROA is 25%, if not 30%, and they're just around, like, just right there ish, a little bit straying away, but just right there. Next, we'll be going over liabilities section, which is section 7, I believe. So on the next slide, we will see that it's very simple for like the basics. So the current liabilities in 2022 is $8,996,000, and in 2021 it is $8,128,000. In contrast, their long-term liabilities are a lot smaller. So in 2022 it is $4,986,000, and in 2021 it is $5,512,000. Adobe does have commitments and contingent liabilities. It usually revolves around non-cancelable purchase obligations and third-party hosting. This is actually enacted, or it started happening in December 2022. And if you look at their annual reports, their fiscal year report, I believe, you can see the calculations from 2023 to 2027, as well as the after period. I forgot what after period. You can see that, and you can see it totals to, I think, $6,090 billion, $1 million. Yes. Next, we'll talk about the current ratio and quick asset test ratio. I mentioned current ratio before, so I'll just read it off. 2022, 1.11. 2021, 1.25. This basically describes the ability to pay off and meet short-term obligations. The expected current ratio is around 1.2 to 2.0. And in 2022, they obviously fell short of that. They are really close, however. This is something they can definitely fix in 2023 if they improve a bit on their current assets and liabilities. The quick asset test ratio is quick assets divided by current liabilities. So you can see the ratio for 2022 is 0.75 to 1, and in 2021 it is 0.84 to 1. So it decreased the ratio. This ratio describes the liquidity, which kind of shows its ability to pay short-term obligations with its most liquid assets. You can see its ability to pay short-term stuff with its most liquid assets has decreased over time by 0.09. So the quick assets have become like more or less than it usually has been. Or there's more of a gap between the quick assets and current liabilities. If you look at it based off like 1-to-1 and whatnot, you can see that they're not able to pay the current liabilities in full with their most liquid assets, which it could probably be 75% at most. Next, we talk about another ratio actually. So this will be the debts to total assets ratio, which is total liabilities divided by total assets. So from this, you can see 2022 has 0.48 and 2021 has 0.46, relatively close to each other, which is pretty consistent, you can say. The debt to total assets ratio, represents a portion of the company owned by creditors compared to shareholders. So I'm assuming this would show the shareholder side, if I have my notes here. Yes, shareholder side. So 48% of the company is owned by shareholders, while it's mostly dominated, or most of the majority is in shareholders. Did I say shareholders? Oh, wait, I think I messed that up. So, sorry, I'm going to recap that. Debts to total assets ratio is creditors compared to shareholders. So this ratio is creditors. There you go. Creditors is 48%. That doesn't make up at least half, or it's at most half of Adobe. But there is more shareholders than creditors. There you go. That basically means that their ratio isn't a safe zone, as we say, or like the financial base it has is protected. It can be protected since it's pretty high, and it is normal, I guess you could say. Next, we will go to Section 8, or the Stockholders' Equity section. So we will be looking at the common stock and mostly stocks in general. So this is based off of a January 2023 update listed in the fiscal year 2022 report, but the common stocks issued and outstanding is 457,800,000. Adobe does not have any preferred stocks, and other stockholder equity accounts they have is the treasury stock and the accumulated other comprehensive income. You can see those on the screen right now. The amount received from common stocks issued is not applicable, mainly because they didn't, I guess, build on that. There is little to no information about that, unfortunately, that I could find. And the amount paid to treasury stock in 2022 is 22,843,000, while in 2021 it is 17,399,000. The amount paid in dividends is not applicable because Adobe does not want to pay dividends and do not intend to in the near future. Looking at cash balances, this is an increase in cash balance. Next, we'll be looking at the ratios, which is, I think there's 5 total. However, you can't really find 2 of them because Adobe does not do dividends. So the dividend payout ratio and dividend yield is not applicable. We're going to earnings per share. This could be found within the income statement of the financial statements, I believe. So in 2022, the earnings per share is $10.10. I believe this is the diluted earnings per share. And in 2021, it is $10.02. This usually represents the monetary value of earnings per each outstanding share. So this is, I guess, how much, this is not how much it is, but like the percentage, or like, not percentage, monetary value of shares, basically. Usually it kind of stayed around the 10% range, or not 10%, $10 range, the low $10 range. The price earnings ratio is the value of a company that compares its stocks and earnings. This is determined by the market price per share of stock divided by the earnings per share, EPS. In 2022, it was 39.32, and 2021, it was 60, flat 60. It was actually rounded up from 59.99. But you can see that it was like at least a 20% decrease. Just kind of doing quick math in my head, but that is nearly almost half the ratio from price earnings. So you can see that there's like a significant difference. Next, we will look at the return on stockholders' equity, something we are probably familiar with. This is the measure of a company's efficiency in generating profit and the profitability in a general glance. Sorry, I can't find the words. So this is calculated by net income minus preferred stock dividends divided by the average common stockholders' equity. Since there's no dividends, it would just be 0. So it would just be net income divided by the average common stockholders' equity. So you can see the math there. It would be 33.85% and 32.59% in 2022 and 2021 respectively. This is like a big increase, or not a big increase actually, but yeah. Sorry, I had notes, but basically the return, or the ROE I'll call it, it is a lot higher than what technology companies usually have, which is 18%, and they have 33%, close to 34 in 2022, and you can see it kind of increased over time from 2021 to 2022, which is showing slight improvements in like their efficiency. Yes, it is efficiency in generating profit and the profitability. Next, we go into section 9, which is the statement of cash flows. So the statement period goes over the year ended November 30, 2022. This is what the fiscal year usually is for Adobe. The statement of cash flows page is on page 57 of their fiscal year report. And according to that page, the ending balance of cash and cash equivalents is $4,236,000. Is this the same as the cash and cash equivalent value on the balance sheet? Yes, it is. They use an indirect method of stating their cash flows. Mainly, you can tell because when you look at the cash flows statement, which I unfortunately don't have on the slide, you can see that it has a depreciation expense there, and it counts other non-cash transactions as well. When you usually use a direct method, you would not include those. So yeah. The net cash flow of investing activities was $570,000. It is an outflow, so that means it's a negative value. The net cash flow for financing activities is $6,825,000. And personally, I thought it was a big outflow. I was like, wow. But yes, negative number outflow. Within the investing activities category, the largest cash flow was the purchase of short-term investments. This is also an outflow, so negative value of $909,000. Lastly, the net cash flow from operating activities is $7,838,000. This is the only inflow, aka the only positive value. Next, we'll go over quick numbers that we'll probably see the equations. So, the net income in 2022, I put 3 years, is $4,756,000. We've been seeing this number a lot. In 2021, $4,822,000. And in 2020, $5,260,000. The net cash flow from operating activities in 2022 is $7,838,000. In 2021, $7,230,000. And in 2020, $5,727,000. The major items accounting to this difference is the stock-based compensation, which kind of took up a lot. I noticed in the 2022 stuff, it was like negative balance or outflow of $1,000. Like, oh, that's big. And then next is the depreciation, amortization, and accretion. That is the second highest. I think in 2022, it is also like around 800. Next, we'll go over the ratios. So we will be going over the statement of cash flows. First, we'll go over the current cash debt coverage ratio, which is basically, well, like a liquidity ratio of how they can use their cash from operating activities to pay for the current liabilities. So in 2022, it was 1.04. In 2021 is 1.16. 2020, 0.84. So you can see that change from below 1 to greater than 1. So that means in 2021, it became capable of using its liquid assets to buy or cover the costs of their current liabilities. However, that's kind of was different in 2021 in comparison to 2022, mainly because that it is a lot, not a whole lot, it is higher than 2022. And 2022 is closer to 1, so that means like it's just a tiny bit higher than their average current liabilities. So they'll just have like a little bit of liquid assets available once, or liquid cash available once they pay for those current liabilities, assuming that they use that liquid cash to do so. Next is the cash debt coverage ratio, which is the same concept, but instead of current liability, it is total liabilities. So in 2022, it's 0.6134. In 2021, 0.6163. And in 2020, 0.5390. So you can see it's a slight increase over time, but in general, they aren't necessarily able to, I guess, pay for total liabilities in general. I don't want to say that the current liabilities make up that percentage, but with the cash, the liquid cash they have, they'll probably only cover 60%, around 60% of the total liabilities, which necessarily isn't a good thing, I believe. Yeah, so the next thing we'll look at is the free cash flows and the cash return on sales ratio. Free cash flows is basically the amount or the leftover money, you could say, companies have after it pays its daily expenses, and usually operating expenses. So you can see that free cash flows in 2022 was $7,396,000, 2021 $6,900,000, 2020 $5,308,000. So you can see it's increasing more and more over time, which kind of basically means that they're having more leftover money from after paying its, what did I say? Daily operating expenses. That can mean that they're having more capital expenditures. It can also mean that having more or less operating expenses. That's kind of an unsure thing, or you can look at the statements to find out. But that amount has increased by a lot over time, at least by at least a million from 2020 to 2021 to 400,000 ish in 2022. The last ratio should be the cash return on sales ratio, which is basically what determines the efficiency companies have towards putting their sales, returning their sales into profits. So you can see it's actually pretty consistent, like almost thoroughly consistent through 2020 through 2022. So it's 0.45, with the exception of 2021 being 0.46. So this basically means that it's been the same for 3 years, practically, about. And if converted, these decimals are practically 45%, 46. And that's also pretty high for a return on sales ratio. It kind of indicates great efficiency in turning sales into profits, which can kind of explain the leftover cash, I guess you could say, or probably the cash provided by operating activities, etc. And that should be the not conclusion, but like the end of the statement of cash flows. So that covers all 9 sections. And next we will go over the overall evaluation and my personal recommendation. So straight to the point, I would say that I would recommend someone to buy Adobe, even though it isn't one of the most top performing stocks, I guess you could say. If you look at the top 500, it is not in like the top 10 or anything, but it does have some benefits and downsides. I'll go over the downsides first. So if you're looking towards inventory and dividends, Adobe does not have any information regarding this at all, so you might want to be wary of that. This may be because their inventory technically is online, so they have an unlimited amount. And we know why that they choose not to pay dividends. Another another downside is that their quick assets is greater than current liabilities, so they're less capable of paying short-term obligations with their liquid assets. And a problem I had, which I kind of found confusing and probably concerning if you were to buy stocks, is that there's not too much information regarding their stocks. The only thing I can really recall that like shaped something was the shares issued and outstanding, and that the par value, I believe, was like 0.0001, and I couldn't find a lot of data afterwards. On the other hand, the benefits of buying a stock from Adobe is that the company value has been increasing over time. Although like some would like to argue that it's not the best stock to buy, it has been having record-breaking increases. They've been facing a lot of year-over-year growth recently. I think in one of their departments, the digital section, they had a 14% year-over-year growth, and in revenues in general for the fiscal year that just ended recently, they had a 12% year-over-year growth, which is pretty impressive. They have a high or great profitability, efficiency, and high liquidity in terms of using liquid assets to pay for current liabilities. The current ratio is above 1, so they have what did I say again? They're able to pay off their debts quickly, I guess you could say. Sorry, I forgot. They also have a low debts to total assets ratio. This basically means that their the financial base is secure. Their stuff can be protected. There's more shareholders, stockholders in comparison to creditors. Last but not least, they also have a high capital expenditure ratio, which basically means that if needed, they can buy more or new PPE. They can also you buy that without having to have additional external financing. The PPE expenses can also cover that, basically. If you hear background noise, I'm so sorry. It's kind of busy in here. But yes, my overall recommendation, you can buy these Adobe stocks. And that concludes my presentation. You can see my works cited. This is from the Adobe links And if you've been paying attention to all the slides, you'll have the Adobe webpage or the homepage of Adobe in the bottom right corner. And then this is my works cited for the other links.